Well, thank you for the opportunity to speak here today. I think this is a very important topic, and I appreciate having the chance to address such a distinguished audience. I'm not going to try and define shadow banking. I'm not going to try and get into the terminology issue. I'm just going to take it as it is because I need simple words to use. But let me start with a political point, which is that society places its trust in financial authorities, and financial regulators are charged with the responsibility of ensuring that financial services support the real economy. And as we've discussed, the economic function of financial intermediation is to match end investors and issuers when you boil it all down. And to do so, of course, without posing risks to the wider economy and to society as a whole. I think in the light of the financial crisis, where the taxpayer and central banks went to extraordinary lengths to provide additional capital and liquidity to stave off the total collapse of our financial system, and in the light of the substantial regulatory reform agenda of the last 5 years, which I think Kay has quite neatly summarised certain parts of it, society reasonably expects financial authorities to understand the financial system and to mitigate the risks of another financial crisis. I can tell you, having completed one of the first post-crisis analysis of the data gaps which financial authorities faced a few years ago, it's simply not acceptable that a future crisis could be managed in a similar way with the similar lack of data and a lack of timeliness of data. This is an extract of a paper I wrote a few years ago, and it just has a number of questions in there that follow the timeline of certain instances in the crisis, and the types of questions require data to answer them. And of course, the data and the questions ultimately were going to lead to decisions in a moment of crisis to actually mitigate the effects of the crisis. The simple fact of the matter was that the data was not good. And as Kay has rightly outlined, a big initiative has been undertaken to gather more data. But I want to say something about that in a few minutes. Clearly, good data supports targeted, timely solutions and fewer unintended consequences. Good stewardship of the financial services industry requires that financial authorities can monitor all of that data and use it productively. But we know that there are interlinkages between different parts of the financial system and that these interlinkages make the system more complex and more fragile. So there are choices in that vein between connectivity and fragmentation. We can allow connections between different parts, banks, non-banks, trading desks and banks and so on, and at the very least monitor where necessary and mitigate the attendant risks. There are alternatives as well too, which is to isolate certain parts of the financial system, almost to put them out of harm's way so they don't infect other parts. So there is a choice there. And I think for the most part, legislators have largely chosen not to go down the route of wholesale isolation of certain parts of the financial services sector. So I think given the interconnectedness between the shadow banking sector and the rest of the financial system, we shouldn't be surprised that at the very least shadow banking activities are subject to regulatory reporting requirements, and that these are ramping up. I think this is a necessary part of this mandate that I referred to at the very beginning of financial authorities for safeguarding financial stability. But it's not a sufficient condition for ensuring that. And I see a public good problem there, which is, and let me just paint it in a slightly different way. I'm struck by the fact that many countries have ploughed tens of billions of euros into strategic defence, into surveillance research. They can track millions of communications per day, and they use the best minds in industry and academia. Yet in the area of processing all of this data that we're starting to gather, I'm not aware of a proper conversation that's been had where the infrastructural, the technological, the intellectual investment has been thought about, and the resources that are required to actually fund that has actually taken place. And I do fear at present that all the best minds that could be working in this area are actually focused more potentially on internet technology, communications and surveillance. I guess the image I have in my mind as well too is what happened in the Cold War back in the 50s in the US, where the RAND Corporation and various Bell laboratories and various other institutions ploughed lots of resources back to a large extent by the public sector and attracted the best minds as well too into this area. we are gathering all this data, but I think the public good problem now is how are we going to invest to use all this data constructively to mitigate potential financial crises for the future. Clearly, the FSB's initiative in relation to the legal entity identifier is a key initiative in all of that, but it's the tip of the iceberg in the context of the bigger issue of setting up the right monitoring and processing infrastructure there. Let me make another point, which I think is important in the context of the shadow banking system, which is, the prospect of regulatory reporting may be seen by some as an onerous step, is a necessary step, and it's a necessary step as part of a disciplined policy formation process. That discipline that I want to talk about, I tried to summarize in that chart up there, which sets out a spectrum of regulatory intervention, which moves from one level of intrusiveness to another. At the least intrusive end, we're monitoring, we're gathering data. Then we analyze, we ask questions. Then we think about policy formation, and we bring in lots of considerations, including political and social considerations. And then we think about rule writing, and then supervision of the rule book, and then enforcement against the rule book where there's breaches, and ultimately there's resolution. That's that spectrum of ever-increasing, ever-intrusive regulatory engagement. When approaching the regulation of shadow banking activities, I think it's important that legislators and policymakers maintain a level of discipline in deciding upon more intrusive levels of regulatory engagement so that each step is backed by quality data, sound analysis, and, as was mentioned earlier, thorough cost-benefit analysis. And I think in some cases that discipline has actually been lacking in recent years. So with all of this new data that we're gathering, I think we need to harness that to improve the policy formation process and also to calibrate the next steps along that spectrum of regulatory engagement. You will all have seen various papers that are written about the shadow banking system. There have been various comments made about the value that it actually poses to the real economy. It's important to actually just emphasize that and remind ourselves not just of the provision of credit, but there's also risk diversification benefits, credit risk mitigation benefits, liquidity management, and also tailoring risk return profiles, even through structured finance. But we also know that there is not so good reasons for the existence of shadow banking centred on regulatory arbitrage and also what I would describe as spurious financial innovation. We need to be mindful of that. I think you're probably all aware of the orders of magnitude here. We're talking about a sector which globally stands at slightly over $71 trillion. Just as, for example, global GDP was about $85 trillion in 2012. This is substantial, and as a size of global financial intermediation, it's roughly about a quarter of that, which is around $290 trillion. It is clear that as many European banks focus on repairing their balance sheets, there is a need for other forms of non-bank intermediation to serve the real economy. And we have seen various initiatives in that space more recently in the fund space, for example, through UVECA, USIF, and LTIF, and so on. Some might argue that the aim of non-bank intermediation is to circumvent bank capital rules, but I think we need to be careful here. We need to ask the questions, what are the economic risks that we seek to mitigate through, if we are to use bank-like regulation in that way? And are we comparing like with like? For example, not all non-bank intermediation creates leverage, particularly in fund structures. And most shadow banking activity does not rely on either directly or indirectly central bank support or deposit protection schemes. I think the most obvious risks relate to investor runs, leading to asset fire sales, leading to interruptions in the flow of credit to the real economy. They relate to pro-cyclical effects which amplify the credit cycle. And I think another point which I will elaborate on a little bit is they relate as well to the potential for weak credit assessment, which leads to bad loan origination. Financial authorities need to take stock in the first instance of their current toolkit, that has been already elaborated on, which can help to mitigate many of the risks. For example, various parts of funds regulation deal with liquidity, concentration, and even excessive leverage. But where new tools are being considered, for example, macroprudential tools, it is important that they are not considered in isolation from the regulations which apply to other sectors. So there's an issue of coherency which I'd like to stress. Just back on the point of credit assessment, I think this is one area that deserves a lot more attention, which is it centres on the operational capability of non-banks to assess credit, monitor loans, manage impairments and write-downs. Unlike equity investments, when loan investments go wrong, there are deadweight bankruptcy costs which impact real businesses and the real economy. And there's a difference between loans that go bad in the normal course of business, which is linked to the business cycle, and an excessive stock of loans which stem from systemically poor lending practices. And I think the comparisons between different regulations can play a role here, because CRD does have something to say about this, but other areas of financial regulation have actually very little to say about the quality of loan origination. So just to conclude, the shadow banking system, I think it plays a very valuable role serving the needs of the real economy. And I think, as has been said earlier, it is here to stay, and we need to think constructively about it. Regulatory engagement with all aspects, all parts of the shadow banking system, I think, is inevitable, at the very least through monitoring the system and gathering data. And that, of course, is a first and necessary step in a disciplined regulatory formation process. And finally, I think coherence with other areas of financial regulation is necessary if we want to avoid unintended consequences. Thank you.